My name is Josh Garland. I will be the host of today's event. I am a financial advisor here at Apriem Advisors. I've been with Apriem for about 3 years, but I got started in the business back in 2009. I became a chartered financial consultant in 2013, and just over a year ago, I became an accredited investment fiduciary. Today's speakers are Benjamin Lau and Jose Rendon. Benjamin is the Chief Investment Officer here at Apriem Advisors. He graduated from UC San Diego in 1998 with a BA in economics and later went on to become a Chartered Financial Analyst Charter Holder, or CFA. Ben has over 2 decades of experience in the business. He got a start in 1998 at Fidelity Investments and joined Apriem in 2002. Most recently, earlier this year, Ben was interviewed by Investors Business Daily, giving his top 3 ETF picks in a changing rate environment. Joining Ben today, we have Jose Rendon, who is a portfolio administrator here with Apriem Advisors, and he sits on our investment committee. He graduated from Cal State Long Beach with a degree in finance. While in school, he was an active member of their highly respected SMIF program, which is the Student Managed Investment Fund. He loves giving back to his alma mater and is currently sits on the advisory board for the Cal State Long Beach Finance Department. Today, Ben and Jose are going to cover the permanent problem with transitory inflation. And with that, I'm going to hand it over to you, gentlemen.
Thanks, Josh, for the nice introduction. Yeah, I love these webinars that we do, and I'm glad. Thank you for everyone for joining us. I'm excited for this. This is an exciting topic, right? You know, I can't think of anything more pressing right now than talking about inflation. It has been such a huge topic in the news. Last week we had a huge print in CPI, and inflation. It seems like it's running hot. And it's in everyone's, it's on the front of everyone's mind, right? And so, and we're feeling it everywhere. So today, you know, we're gonna have a quick agenda for you. We're gonna quickly define what is inflation. It's such a nebulous topic, a nebulous concept. What is it really? What is inflation? Give you an update on the current state of inflation and some of the problems we're seeing. And then ultimately, probably the most important thing, how does inflation affect your investments? So we have a pretty simple agenda today. We have some great data. But really, as we always do, let's just make this pretty informal. Throw out your questions and put them in the chat box. Send them over to Josh, and let's help answer some questions. Right. So without further ado, let's talk about inflation. What really is inflation? It is something that we feel a lot of it every day. Right. It's something that is tangible. Right, and we feel every day when we go to Stater Brothers or Albertsons, when we go to the grocery store or Ralph's, depending on where you live, or we feel every time we go to Costco or fill up gas. You know, those are really tangible ways we can feel inflation. But there's also things that inflation affects that we don't really feel. That's harder to conceptualize. The biggest thing I think some clients feel, many of our clients feel, is how does inflation relate to Social Security? And for the first time in a few years, many of our clients that are receiving Social Security payments are seeing a nice bump up in their payments. But inflation also feeds into other things too, like interest rates and what the Fed does. It is one of the dual mandates that the Fed has here, at least here in America. And the Federal Reserve really is charged with keeping inflation low or in a moderate level and going for full employment. And so that's why inflation is such a big topic right now, because it affects so many parts of our lives in a tangible and intangible way. But before we do that, I think it's important to really define inflation. There's so many different ways that we hear about inflation. And so Jose's going to talk about that.
Yeah, so there are various ways to measure inflation. And that's really important to note because everything that you're really hearing in the news is relevant to the consumer pricing index. However, this isn't the one and all index for inflation. As another measure, there is the personal consumption expenditure index, and that's really what the Fed uses to gauge inflation in the United States. And between that, there's also several varieties. There is the headline. However, there's also the core. Because you do see volatility in food and in energy that is stripped out. So that would be the core CPI, core PCE. So again, keep in mind when you do see these headlines, news, it really alludes to the main headline index. But then there's also other customized indexes, such as the Big Mac index. You know,
yeah. And so, you know, I think many of you would know that I'm a big fan of the Economist magazine, and the Economist magazine comes out with this Big Mac index. I think it started off in somewhat of a fun terms, but it really is a quick measure of how much does a Big Mac cost across the world, right? Whether it's here in America or Japan or Russia. and it's something that's pretty universal that everyone likes to eat. But Economist is a great other index of inflation in terms of Big Macs, and I think it's really funny how they do that.
Yeah, and just to carry on with the ways that inflation is measured, we'd also like to note what the weights are for those indexes. The largest weights to those indexes are housing and transportation, and that's specifically for the consumer pricing index. And as we've noted, many of you might be buying cars right now. Obviously, most of us do drive. And we've noticed gas prices tick up. And if you are looking for used car prices, not just used car prices, but new car prices, you are seeing these prices move substantially up. So moving on to that, we can go ahead and cover the main differences, CPI and PCE. How do they compare to each other? On the left-hand side, we do have the weights for the consumer pricing index. And you can clearly see that there are some major differences. CPI specifically does cover out-of-pocket costs, and it does cover housing and medical care, versus PCE. This isn't only out-of-pocket costs. This is also covering nonprofit organizations that are paying towards consumers. The biggest driver there would be medical care. So you do see on the left-hand side that CPI has a smaller weight to medical care versus PCE, which is a bit heavier. And the reason for that is that out-of-pocket costs for CPI are exactly what's coming out of your pocket, versus PCE. It actually covers what you're getting through, like your insurance. There's additional expenditures by others that aren't just you. And that's why there is a larger attributed weight there. But also for housing, we aren't looking at price appreciation. You're really looking at what rent is doing. For an owner, obviously there really isn't a change in price there, but if you're looking to rent a house, you have seen noticeable prices. So those are the two biggest differences.
And so if you look at these two measures here, right, and we highlighted housing and medical care costs as two of the biggest concerns, and we do that because those are some of the biggest expenditures that a lot of our clients have, right? Housing, big spend for many of our younger generation clients because they rent. Medical care costs, this is one of the biggest spends for many retirees that often people forget about, and so it's noticeable that the two different measures of inflation really count for them differently.
Mm-hmm.
So.
Yeah, and really noticing that there have been huge scares like, whoa, inflation is out of hand. It's really hot. Really, we'd like to position where exactly are we with inflation? Yeah. Are we getting to a point where we're heading to a point that inflation is going to overrun and run away from us and head into hyperinflationary territory?
Well, I don't know, Jose. I mean, that's been a big topic, as you said, really in the last week or 2 weeks, right? As you alluded to at the beginning, we got a big print last week on CPI. That was the headline grabber. It came in about 6.2% as the headline number, the overall number for CPI, and that caused a lot of people, a lot of famous people. You're talking about Jack Dorsey from Twitter and Square fame, Michael Burry from The Big Short, talking about, hyperinflation is here, and we're going to go back to the Weimar Republic. I don't know if that's true, right? And I want to take a quick history lesson on what happened back in Germany about 100 years ago, right? Everyone talks about Germany and when they had this huge inflation with the Weimar Republic, and it really was due to a couple reasons, right? Germany at that time was facing huge budget issues. They couldn't pay back the reparations they had to pay towards much of Europe. So they had to print a bunch of German marks to pay for that. Right, and then and on top of that was a political nightmare situation, given that this huge inflation was happening. The German political environment was very unstable at the time, and so you had this huge devaluation of the German mark relative to gold at the time. And over that time period, over this 10-year time period, inflation was literally about 80 million%. And so you're having a huge amount of inflation. And when you take a look at inflation last week, that we saw last week, it was 6%. I think that puts it in a much more better context. I don't think we're at this stage in hyperinflation, at least not yet. And frankly, we're not even there what we saw in the 80s. And so this is what we see a lot of the time too, that everyone equates what they did in Weimar with printing all this money and flooding the world with German marks. Everyone equates money supply and inflation. And I think that's one of the biggest things that people get wrong, right? Money supply does not equal inflation. It never has. It's part of the equation when we talk about inflation and from a theoretical basis, but inflation is much more than just money supply, right? It is about demand, demand and supply. It's about the velocity of money, right? Does money move around a lot? And right now we're not seeing any of that happen. Right? And what we printed out here was a chart of M2 money supply, and that has been increasing, especially here in the most recent years, right? You see this huge increase in inflation due to COVID. And then you saw it again, obviously, after the great financial crisis. And then the blue line is the CPI that Jose was mentioning a second ago. You can see, and when you graph out the money supply in green and the CPI in blue, I don't notice any correlation, and almost a negative correlation, quite frankly, right? We tend to print money when inflation gets too low. And so that's one important thing that we have to remember, and we would like to remind clients. Money supply and inflation are not the same thing, right? And when we see bouts of hyperinflation, hyperinflation sometimes is caused by increasing money supply, but the issue with hyperinflation is usually more of a political crisis, not a monetary crisis. And so what we did here is we graphed something a little bit more recently than 100 years ago in Germany, right? So we looked at 3 countries here that have kind of similar situations. Venezuela, right now, currently, Japan, in the last few decades, in the United States, right? And this is the inflation rates in Venezuela in blue, the US in green, and Japan in red. And you can see on all 3 cases, there was a general printing of money, right? The Japan doubled its money supply. The US increased the money supply of about 30%. Venezuela has increased the money supply by about 80 million. And so you can see here that inflation has really only affected Venezuela. And because Venezuela has had that political instability, whereas even though the United States and Japan did print a substantial amount of money, the political stability in both US and Japan have led to really tame inflation. And so you're not seeing those increases in money supply really leads to inflation in US and Japan, whereas Venezuela, with everything that's been going on under Maduro for the last 5 years or so, 6 years or so, they've really seen some big issues. So when you look at hyperinflation, I think you really have to look at it as a political situation and not necessarily as a monetary situation. What we also wanted to do is zoom in here and look at just US inflation recently and give you a little bit of a historical context, right? And so this is the last 50 years inflation. This chart is from JP Morgan. In the light blue is headline CPI, and this is focused on that. You can see the headline number always peaking up to the right here. It came about 6.2 last week. And so here from a historical context, yeah, it is quite high. Let's be honest. It is quite high and trending to the higher end of the range, but we've been here before, right? We've been here at this level back in 2007. We were out here in the 90s, and obviously you saw we had the hyperinflation, the higher inflation in the 70s and early 80s, right? But still, even at those high inflation levels in the late 70s, it's still nowhere near the hyperinflation that we were seeing in Venezuela and what we saw in Germany. But still, inflation is running hot. The question is, where do we go from here, right? And that's the biggest psychological impact that inflation has. We don't know how long this is going to last. Is it going to be a short blip like it was back in 2007, right? When we saw gas, and for those of you who've been around, we saw a huge spike up in gas prices, right? That's what last time gas prices were at $4 a gallon, and right before the financial crisis. At that time, we didn't know that inflation was just going to be temporary, right? It was a very short and quick hit to all these costs, but it did come down really dramatically during the great financial crisis. We don't know what's going to happen here. You know, how do consumers price in or budget for higher inflation when we don't know how long this is going to last? And so that's the question. How long is inflation going to last for? As I said, over the last 12 months, the most recent print showed that inflation was at 6.2%. So when we look at a year from now, what do you think inflation is going to be like over the next 12 months? So we have a quick poll for you. Wanted to get everyone's thoughts on where do you think inflation is going to be over the next 12 months from now into October of 2022. So Josh, you want to put up the poll?
I have the poll up right now, so everyone can see their options there on the screen. So what do you think that the CPI will be for the next 12 months? Is it going to be more than 6%? Is it going to be between 4% to just under 6%, between 2% to just under 4%, or less than 2%? So we'll give everybody some time to go ahead and submit their vote on what they think is going to be the results there. And so I'm going to list off the results. But before I do that, now, Jose, you can give your answer to Ben's question. What do you think it's going to be over the next 12 months?
Well, I do have a really biased answer because I do get to look at this on a day-to-day basis. However, just taking a group picture of like some of my family and friends, I mean, their worries is, hey, food, is it gonna double in the next year? I mean, I get the calls all the time, you know, like, should I be worried? Should I be saving more? So I think for those people, I think they might think that we'll see at least 50 to 100% raise in prices. So how does the poll compare there, Josh?
Well, our poll says, I'm going to start at the bottom. So 4% of our respondents said less than 2%. Then we had a tie. 17% said between 2% and 3.99%. And the other 17% said more than 6%. But overwhelmingly, 63% of the attendees said that they believe inflation will be between 4% to 5.99%.
Right, that's interesting. That's interesting to see. So I guess most people are pricing in that higher prices, at least for the next 12 months, right? And I'm imagining that everyone's got the reasons for it, the supply constraints, the huge demand that we're seeing. What do you think the market's telling us, Jose?
Yeah, so really some of the comments that we have heard specifically from the Fed is regarding inflation being transitory. And thinking about that, you know, what does transitory actually mean? And what I wanted to point out here is that transitory doesn't necessarily mean it's going to be over in the next 6 months, in the next 12 months. And as we noted, most of our viewers are thinking that inflation is going to be within that 4 to 6% range. But we'd like to take a look at what market participants are guessing inflation is going to be. So this chart here is showing inflation, the average inflation 5 years out from now, and then going 5 years forward. So it's saying that currently we're looking at about 2.3% inflation. And that's not all that bad looking at the headlines that we're seeing now. And just to take it into historical context, the Fed really has had a tough time reaching their 2% inflation target. And a 2.3% inflation over the next 5 years isn't all that bad. Again, we're not seeing hyperinflation, we're not seeing it run away, and we're not seeing a huge spike in what market participants think inflation is going to do.
Yeah, and again, I think it's important to note that this isn't what we feel, right, or what we're saying to expect. This is what the market is telling us through interest rates. And the market has generally been pretty accurate if you look at the historical context. And yeah, the market does look longer term. It gives you a 5 to 10 year expectation of inflation. And the reason why we use it is because it's a longer term average, right? And so this is really what we think the Fed is looking at. And clearly, Jose is right. I think that inflation, the market is saying that inflation is a bit of a problem, but not that big of a problem on a longer term. Probably expecting things to cool down after about 6 months, but we'll see what happens there.
And so just so I can clarify, when I'm looking at this chart, right, is this representation of 5-year forwards contracts, right? And so you actually have folks that are out there that are trading on what their expectations are for treasuries looking 5 years forward.
Yep.
Right. So, you know, for all of our listeners, just to kind of talk about, you know, when we say this is what the market thinks, you have traders that are out there that are putting money up on these expectations, right? And so that's what, when we say that this is what the market feels, this is what the market's telling us, there are folks that are actually trading on this valuation, expecting, you know, in 5 years for inflation to be around 2.2%.
Yep. So yeah, I think that's pretty interesting, and I guess you know, we'll see what happens. And there's a lot of issues right now that the economy is facing, right? Whether it's the supply constraints that we're hearing about. Jose is a resident of Long Beach, so he sees all the shipping containers off the coast there, and all the backlog that we're having, and we see that you know, just buying goods for Christmas and the holidays, right? It's been tough to get some of these supplies, and on top of that, the huge surge in demand for things like cars and refrigerators and everything, you know, related to the home. And so, yeah, we'll see over the next 6 months what happens with inflation, and see if we can get some of these supply constraints relieved here. But the biggest issue for me is that that we want to get across to clients is that inflation, as no matter how was to define it with CPI or PCE, or even if you use the Big Mac index from The Economist, inflation really is a matter of perspective, right? And again, it matters of who you are, what your situation is, frankly, where you are in life, right? And so we took out these two big items again, real estate cost and medical cost, out of the CPI and the PCE index, and want to take a different perspective about it. For most of our clients, or at least, I'm sorry, for the vast, 68% of Americans that do own a home, is the inflation that we're seeing in real estate prices an issue for them? If you're locked in for a 30-year mortgage, or if you own your home outright, you're not really experiencing 40% of the inflation number. You're not experiencing that real estate inflation that many people are feeling, right? If you're generally younger, if you're renting, you don't own your own home yet, you're feeling that real estate pressure a lot more than maybe my parents or I do, right? Because I already own my home. And so that's a matter of perspective. Again, medical costs, right? Medical, again, one of the biggest costs that Chris sees in his financial planning, and Chris is the financial planning team. Medical costs are a huge percentage of expenses for our retirees. But that really relates. How does that really affect you, the end client, right? Are you covered by private insurance? Do you have an employer that has that gives you private insurance? Are you on Medicare, right? And you're seeing those huge medical costs really ramp up. For our younger clients, they don't really spend too much on medical costs, right? And some of them don't even have insurance up until recently. And so all their needs are really taken care of. And so medical cost is a big portion for our retired clients, not so much for our younger clients. And it just really matters, I guess, what stage you are in your life and what stage you are in terms of where you are in your career life. And so it really is a matter of perspective. Also, when we look at who are you in terms of what your asset mix is, right? What happens if you're a real estate landlord, right? If you do own a lot of real estate, you do rent out to tenants. The real estate inflation is actually a good thing for you, right? That's what you want to see, right? When we see about increasing rents on your tenants, that's actually a good thing. Inflation is a good thing for you. That increases your cash flow. So really, I think that's an important thing. It's a matter of, you really have to look at it when you see the headline news. It's cause for concern. But really, if you look at your expenses in your situation, I think you have to take a closer look there. And so,
I think this is a great time to point out that one of the questions that came through was who gets hit hardest by inflation. And I think the slide really kind of goes through and answers that question. I mean, really, it's a matter of perspective. It's good for some people and bad for others, and it's really is a matter of perspective and where you're at. Kind of determines who gets hit hardest by inflation.
Exactly. I do want to break it down, Josh, in terms of where you are in your life, right? And so one area that's caused a lot of inflation really, and you hear about this, is the inflation in wages, the wage growth, right? You're hearing employers like Amazon and Walmart raise wages in the last few years. And so they're causing some of this, right? And wage inflation, as many of you know, is a really tricky thing for us, right? This was the biggest source of inflation that we saw in the 70s. And some would attribute wage inflation in the 70s as a big reason why we saw overall inflation during that time period too, a few years later. It's also difficult as an employer, right? You can't really, once you give someone a pay raise, you can't really take it away. It's not like gas prices where it goes up and down, right? Wages are generally pretty sticky. So what we did here is we graphed out two types of wage growth, but for different types of Americans, right? On the green line, the top green line, that is the bottom 25% of wage earners in America. The blue line on the bottom is the top wage earners in America. You can see here the blue line, the wage growth for the top earning Americans it's been pretty muted. You're coming about 3%. But the bottom 25% of wage earners, they're seeing the huge inflation right now. They're seeing the huge increases in their wages. So they're really affecting it. And I think this is actually a good thing, right? Again, inflation is a matter of perspective. And so finally, after decades and decades of weak wage growth, you're seeing that the bottom 25% of Americans are finally seeing some gain in their paychecks. I do imagine that a lot of it's due to retail, a lot of it's due to the Walmarts and the Amazons, like we were talking about, them raising prices. Also talking about waiters and hostesses at restaurants, they're seeing some wage increases too. So that's a good thing, right? I think that's a generally good thing, and hopefully it'll let these type of Americans really deal with the increasing prices at the pump and at the grocery store.
Do you think that this increase in wages contributes to at least a piece of the inflation that we're actually seeing at the same time, right? Because now we're making more money and therefore spending more money. And I know clearly based on all the boats in the harbor, there's been a lot of consumption and spending that's been happening. Is there a correlation that's there?
This is one thing, this is one factor, but I don't think it's a tight correlation, Josh, but I think it's definitely one part of it. I think the huge demand that we're seeing really in all the goods that we're using is really from the top part of Americans, right? You're seeing the blue line, the top wage earners. They're really the ones that are spending a tremendous amount of money on goods from Amazon and buying products and new cars, right, and new homes. I think the bottom part of America that's seeing the wage gains is just causing them to be able to keep up. I don't know if, at some point you could see more consumption across the board for all economic classes, but I don't think you're really seeing that yet. I think you're seeing just a huge increase in demand from the top part of America.
So all those home improvements during COVID.
All those home improvements during COVID, yeah, exactly. And so, yeah. So we wanted to talk about how inflation really impacts your investments, right? And so we talk about different asset classes, especially when we look at what we own for you. And so we looked at the 4 different asset classes: stocks, bonds, cash, and then the most popular one recently has been gold, right? And we want to talk about one by one. Stocks, we continue to think stocks are one of the best areas to be in. The best companies have good pricing power and can adapt. Bonds have actually done okay during inflation, but I think at this stage in the game, I don't think that's the place to be. You can look at other asset classes within bonds. I think cash is obviously very tough. People don't want to lock up money in their bonds and they want to hide out in cash, but cash can be very expensive, right? Especially on a real basis. And then the most popular topic we get is gold, right? Gold, we get a lot of questions on gold when inflation runs up. Gold has been running up recently, but when you look at historically, gold hasn't really done much relative to inflation. And so what we did here is that we graphed out gold. This is gold back from about 2001 to about now. You can see gold has rallied quite nicely, right, to about 1860 as of earlier today. But that really hasn't kept up with inflation. When you look back at gold since 1980, right, over the last 40 years, gold has actually not done much, right? Gold is actually negative since 1980. And so I don't know if gold's really the best hedge for inflation. A more popular question we get recently has, well, what about other assets like gold? How about digital gold, right? And we talk about cryptocurrency. That's another one that's been really popular, right? Because of the perceived scarcity in cryptocurrency, is that a good place to hide out during a high price inflation? The store of value for gold and for cryptocurrencies is perceived, right? It's hard to know if there's a really direct correlation there. And so with cryptocurrencies being so new, I think that's a tough way to call that cryptocurrencies are really a good hedge for inflation. Again, I don't think gold is either. So it is happening. We're starting to see some signs that cryptocurrency can be a decent hedge for inflation, but I think with the huge volatility in crypto, I don't know if I'd be using that as a hedge for inflation. Bonds, though, this is a chart of bonds and how bonds, what we think about bonds in terms of, are they a good place to hide out during inflation, right? And so we charted out 2 different things. This is a JP Morgan chart. The blue line is what we call the nominal yield, and the gray line, the dark gray line, is what we call the real yield, right? What's the yield on a 10-year treasury, the blue line, after inflation, right? And so right here, as of the end of the quarter, treasuries are yielding about 1.5%. They're a little higher now. They're about 10 basis points higher now into November, but at the end of the quarter, it's about 1.5%. That's great. That's what we call the nominal yield. And then we look at the real yield, which is accounting for inflation. When you subtract the inflation from the coupon payments or from the yield, you can see as of the end of the quarter, the real yield on these bonds, because inflation was running a little hot, is at minus 2.5%. Right? You're actually losing money on an inflation-adjusted basis when you sit in bonds here. And so this is our big concern with bonds at these levels, especially with the low starting yield of bonds, that with rising inflation, with the changes in the bond market and the longer duration of the bond index, we think bonds are going to be really, really tough to hide out during inflation. And that's why Apriem is underweight bonds. We've also avoided, or we have less and less treasuries in our portfolio. We're looking at other types of bonds that could really protect portfolios. Right now, we're looking at bank loans and floating rate bonds, mortgages, and so we're keeping our bonds very what we call short term in nature. And so really to prevent any declines that we see in the bond market with rising inflation, because I think that's really the big concern, right? And throw in there inflation, throw in there what the Fed could do over the next few years and with interest rates, and I think bonds can be very challenged, at least in the short term.
So that really ties us into what have companies in the S&P 500 done. I mean, inflation didn't just start peaking out its head over the last month. This is talks that have been going on all year long. And then just as of the last week, we did have over 95% of companies in the S&P 500 report earnings. And looking at the earnings that they're reporting, we're hitting record levels. I mean, there are talks about the supply chain, there are talks about inflation, yet the healthiest companies have managed to turn large profits, meaning their bottom line. And really what we're looking at, asset allocations. Where do you want to park your money? Do you want to sit with negative yielding bonds, or do you prefer going into stocks who have continued to grow during this environment? And looking at a different context here, there's a few reports that float around of what other managers are doing. And they have the same positioning that we do. Increase the allocation to stocks, to individual companies, and stay away from bonds that really aren't yielding too much and potentially, again, lose their principal.
Yeah, I mean, this chart's it's a very interesting chart, and when Jose and I listened to all the conference calls, the earnings calls from the companies we own, and just generally speaking from the market, it was a very interesting earnings season, right? And Jose's right, the earnings season is pretty much done right now. We had some retailers like Target and Walmart reporting this week, but the biggest issue that the companies in America are mentioning is inflation. More than 60% of companies brought that up on their earnings call as a huge issue for their business outlook. But then you combine that with these huge profit margin numbers. That's pretty impressive, right? The best companies, especially the companies that we like to own, that have great business models, that have great margins, they're doing something different. They're able to increase prices on consumers and their clients, and they're running at the fattest margins we've seen in honestly decades. And so yes, I think we are probably due for margins to come down a little bit, and I think we're starting to see that a little bit right now, but I think, man, corporate America is quite poised to take on this higher inflation, higher wage costs, higher input costs quite well more than history. And so we're pretty impressed by how they've been reacting.
So that really ties us into performance this year. Real estate, owning property has done extremely well throughout the year. Second in place there is stocks. And afterwards, we're looking at other economies outside of the United States. Global stocks have performed a little over 8%. But then when we stray away from equities, US bonds, global bonds, this is where we're seeing negative returns for the year. And something we don't have here is cash. There are clients who ask us our perspective on moving their entire portfolio over to cash. And, referring to this graph here, given our outlook, we would suggest, again, that there's a higher allocation over to stocks, again, based on that performance.
Yeah, I mean, and if you look at these asset classes for U.S. stocks, U.S. real estate, all these numbers are what we said nominal, right? And so they aren't real. We're going real. So if you want to go with real numbers, then subtract that 6 point, and you think this inflation can be 6%, just subtract 6% from all these returns, and then you get a real return number, right? So if you use 6%, then you're assuming that U.S. real estate is doing a net 24%. U.S. stocks doing about a net 17%, but U.S. bonds doing a net minus 7.5%, 8%. That's really tough. That's really tough to swallow. And I think those trends can be around for at least the next few quarters. And so that's a little bit concerning. And that's why we're so cautious on bonds and so underweight bonds right now. So, I mean, I guess we are coming to the conclusion of this, and we want to really summarize how we feel about what's going on with inflation, right? Inflation is quite high, right? We think inflation is expected to be higher in the short term, mainly due to the massive increase in demand for goods from Americans, and combine that with supply chain issues, it just makes it much harder. We do think, though, that inflation should moderate, in the next 6 months or a couple of years, but we do think inflation is not here to be this high. We don't think we're in a hyperinflationary environment. We think inflation will moderate in the next year or so. But we don't know, right? And I think it's really important to watch these, what we call input costs, things like wage growth. Are wages continuing to rise, right? Are Walmart and Amazon employees going to make $30 an hour in the next 3 years? And commodity prices too. Where are gasoline and oil prices for us? Where are food prices when we go to the store? Are they going to continue to rise? You're seeing some leveling off of some of those issues. But really, how does that affect our investments? We want to focus on growth-oriented companies. We want them to have a competitive advantage over their peers. That competitive advantage really, we think, gives them pricing power to adjust to market conditions, to rises in costs. And so pricing power really gives them the advantage, right? And that's why we think stocks are the best place to be. I would also look at international markets too. Jose just mentioned the international markets weren't up nearly as much as the U.S. markets for good reason, right? They are seeing lower growth. COVID is still much more of an international problem than here in the United States. But with that, they're seeing international markets are seeing lower inflation and lower valuations too. So when you want to look for cheaper areas to invest in, international markets are a greater place to be, and they're seeing lower inflation. Again, if we couldn't say this enough, we're very cautious on fixed income, right? Especially long-term government bonds. We think there's better opportunities outside of government bonds, including TIPS and shorter duration corporate bonds. And as you notice, we're really trying to limit our cash holdings, right? We think cash is going to be a rough place to be. With cash yielding zero, still, I think cash will probably be yielding zero for at least the next year. And 6% inflation, I think that's going to be a real detriment to.
Ben, I know we talked about this before, but how much cash is technically out there just kind of floating right now? Do you know what the current estimates are?
Yeah, I mean, there's a bunch of estimates that you can look at. But when you look at just checking accounts, I'm sorry, savings accounts and money markets, you're looking at north of $15 trillion, right, on the sidelines, earning zero, right, and even negative on a real basis. But they're earning zero just because they want to be safe. A lot of that, I think, some of it will probably go back into the economy, right, as people spend down some of the savings that they've accrued over COVID and buy cars or go on vacations, right? But we think a lot of it's going to come back to the market, and I think a lot of the money is finding a home because it's earning zero. And that doesn't really help anyone's financial plan, with such a big slew of their assets and earning negative real returns.
Okay, are we ready for some Q&A?
Let's do this, Josh.
All right. So we've gotten a number of great questions that have come through. I'm actually gonna pull some of the more basic ones first. One of the questions that came in early on, but you guys were kind of in the flow and I didn't want to interrupt you. It was, do you guys mind redefining CPE one more time? I know we talked about CPI, but what was what was PCE?
Yeah, so there's two ways to measure inflation, or there's many ways to measure inflation. Two main ways to measure inflation is the consumer price index, how much consumers are paying or paying for goods, and then the PC, the personal consumption expenditures, how much people are consuming or purchasing. And so there are two different ways to measure it, but the biggest difference is between the two is how they account for various aspects, right? And so if you look at the light blue, housing, or what we call rental equivalent, is 42% of CPI, right? Almost half. But in the personal consumption expenditure index, the one that the Fed really uses, it only accounts for less than a quarter of the inflation reading. So that's a big difference, right? Depending on where you are kind of in your situation. And we look at medical care costs, right? The green. Medical care costs accounted for less than 10% of the CPI. But on the personal consumption expenditures, it was twice that, 20, almost 3 times that at 22%. And so that's a huge difference in how they measure it. And so that's really one important way. I don't think one way is better than the other. It's just different ways to measure it.
Yeah, different ways to think about it.
Exactly.
Let me get my little Q&A box back up here. So there were actually a number of different questions that were kind of similar to each other, but they all kind of circulated around kind of the concept of how long do you think that inflation is going to last, or can you define what you mean by short term? So when we're talking about these, we think in the long term this, but we think in the short term this. What are your guys' expectations on that? What do you kind of mean by that if you get a little bit more zeroed in?
Yeah, I mean, when we talk about investments and long term, it's all kind of Depends on your point of view, right? Like a perspective, like we talk about. And so we do, when we look at an investment like a stock that we want to own, we do look at it from a long-term perspective of at least 3 to 5 years, right? So for a good amount of time. When we talk about inflation, that's a little bit tougher, right? Because we see it. I personally, I go to a grocery store about 5 times a week. So I see it about 5 times a week, right? And so it's always in your head beating at you. And so I think when we talk about inflation, I think and higher inflation could last another 6 months from now. I think that's a long time for consumers, right? 6 months from now, and I go to the grocery store, 20 times a month? That'd be 120 grocery trips to the grocery store between now and then. I'll be feeling higher pressure. Plus, every time I go to the gas pump, plus I go buy clothes for the kids, right? And so you see that, and I think when I say inflation is going to be higher, I think it's going to be higher for at least the next 6 months. And Josh, let me go back to that, by the way.
Okay.
And so the reason why I say this is because we're starting to see some pressures alleviating. Here's the disclosures page. Pressures alleviating in some of the issues that we saw earlier in the year. And so we talked about shipping costs, right? I think this was a big topic about 2 or 3 months ago now. The huge rise in shipping costs to ship everything from dry goods like grains and copper and metals and stuff across the world to air freight costs. This is what we call the Baltic Dry Index. This is a good measure of how much it costs to move commodities around the world. And you can see here, the cost to move a container of dry goods really went from about $1,500 a container to almost $6,000, a 4x increase in about 18 months after COVID, right? And that peaked really really, frankly, when it was making headlines, quite frankly, in the middle of October. And since then, look at the dramatic decline in shipping costs for many shippers. And so right now, that's not the issue right now, right? So some of these pressures are alleviating, and so you're seeing shipping costs come down. Now we just have to get those containers off the ships and into our hands. But yeah, you're seeing some alleviation in these pressures here. And so you're starting to see this across the board in several areas, right? You're seeing this in some of these metal costs. You're seeing that in lumber costs. So you're seeing some alleviation pressure in some of these goods. You're not seeing it in things like gold. You're not seeing it in things like food yet. So that's what gives us some indication that we think some relief is around the corner, but probably not right around the corner. Probably looking at six months away.
Okay, so another great question that I think that's probably on everybody's mind, right? So we kind of talked a little bit about the risk inherent in keeping cash, right? Just with this higher inflationary environment, the risk inherent in holding bonds, real rates of return on bonds is technically negative anyway, right? And then there's potential rising interest rates moving forward, which could cause some risk in bonds as well. But generally speaking, retirees are taught to think of equities as being, very risky as well. So how do you reduce risk in your retirement portfolio during this kind of volatile markets time?
Yeah, I mean, and it as again, like everything does, it depends on your situation, right? And that's why I think it's so important to do a financial plan with Josh and Chris and everyone on our advice team, right? And having a solid financial plan really, I think, helps number one, alleviate a lot of the risk. And what we do, make sure that we do want to break down what your expenses are. What are some of the expenses that you need to have covered, and what are some of the expenses you would like to have covered, like vacations and just what we call discretionary expenses. So I think reducing your risk is really comes back to the most basic level of having the right asset allocation, having enough reserves that you can make it through some sort of decline in the market. Especially when we're advising clients to have a little bit more equities, thus a little bit more risk in portfolios, given everything we talked about. Having the right allocation to cash, having a right budget, having your cash needs covered for the short term, I think is a really important part of risk mitigation. So you don't have to dip into the portfolios if the market is down 5 or 10 or 20%. And the other way is really, although we are underweight bonds, it's still having a good portion of bonds in the portfolio, right? We're underweighted, but bonds still give you a lot of stability, right? But bonds still give you a lot of ballast when things are rocky. And so we still like bonds. Again, we're leading away from treasury bonds. We're looking at other things like short-term bonds, floating rate bonds, mortgage bonds are really popular right now and yielding a decent amount. And so we're looking at other non-traditional asset classes besides that.
Yeah, so it sounds like the story, and I think this will lead into our next question, is that it just kind of we're more talking about how do those different asset classes line up against inflation in general, not necessarily that you shouldn't be in any of those asset classes. It's just what's going to be kind of your strongest weight against inflation. And so I say that kind of preferencing my next question here. Are you able to go back to the gold slide or the gold, the gold chart that you had on here? All right. And so the question says, if I was reading the slide on gold correctly,
Mhm.
or gold book growth correctly, in 2001, gold was around $300.
Mhm.
And in 2021, gold was 1,800.
Mhm.
That is a 6-time increase over 20 years.
Yep.
So how does that compare to the equity markets over the same time frame?
The equity markets are up about 4 times as much as that.
Yeah.
4 times as much as gold.
And so there's actually a great chart that we have. I don't think it's in this presentation, but it shows the different kind of asset classes as compared to gold, and it shows equity markets, it shows gold, it shows bonds, and it shows cash. And by far, the equity markets have continually outperformed against inflation over time.
The tricky part is also, because I think every chart can be, chart crime or be a little bit misleading. And I chose this chart time period just to show you the huge rep in gold. But what I didn't show you, and I didn't want to cherry pick this data because I think it could be misleading. But look at, if you bought, I don't know many people that were buying gold in 2000, right? I think a lot of clients were buying gold after the great financial crisis. Around here, around 2010, 2011, I also remind you, this is when the Europeans were going through their issues too. And so what happens? What is your return if you bought gold around that time till now? If you bought gold around 2011 till now, about 10 years, you were flat in gold. Whereas, with the stock market, you'd be up considerably. Also,
Yeah.
if you look longer term, from 1980, right, the last time we had this big spat of inflation, till now, gold is flat to negative. So if you look at over a 50-year time frame, gold is negative, and surely if prices have risen in the last 50 years, right? And so I think depending on your time frame, gold can be very misleading, and I don't know if you have to really time gold to get it right. And that's why I think gold is a bad inflation hedge, right? It works over various time frames, but maybe not your time frame.
Right. I think this is a great, a great time and slide to just to circle back around to that, talk about real rates of return as well, right? So you can look at the chart, and like you said, had you kind of bought gold when it peaked out in, mid 2011 at that time period to now, you're not just flat. If you subtract out inflation over that time period, you are in negative territory when you start talking real rates of return at that point in time, because $1,800 in mid 2011 does not hold the same value as $1,800 does today.
True.
Back then, it was worth a lot more in 2011 than it is right now.
I think the case for gold, if I might be frank, is I think the case for gold is really not, if you're long it, I really wouldn't say that it's an inflation trade, right? I think it would be a political instability trade. And I think that if you are a big believer in gold, I think you really would need the system, at least the system in America, Europe, and Japan, and China, quite frankly, to really start collapsing. Right? I think that's the big case for gold, especially at these levels here.
Yeah, yeah. I think part of the conversation there too has to do with how much money's already in gold. It has such a large market cap. I think somewhere in the realm of around $11 trillion, I believe, in gold. And if that's total market cap there, how much more money has to flow into gold to move the needle 1 or 2% up? It takes a lot. I mean, you're talking, you need a lot of believers in gold to simultaneously all be jumping in at the same time to move the needle substantially.
Yeah, and I think, quite frankly, Josh, with the advent of crypto assets and digital stores of wealth, right? I think gold is having more competition for assets than ever before, and so I think gold is probably a little bit more challenged here due to crypto issues.
Well, and to expound on top of that, the total market cap in that crypto space, because it's so young and so new, is substantially smaller than the amount of total market cap, total money that's in gold as compared to what's in crypto. If you add all of the crypto together, it's still just a fraction of the amount of money that's sitting in gold at the moment.
And the question I have is, where does that money come from? If money was to flow more into crypto, does it come from stocks, bonds, cash, or gold? And I think there could be a good case that money can be flowing out of gold and into crypto assets.
Mm.
I think the people that believe in gold also believe in crypto assets too. It's a very similar logic.
Well, we got 1 minute left, so I have one last question. I'm actually going to smash two of them together because I think they go together, right? And it's can the Fed fix inflation, and should we be worried?
Can the Fed fix inflation, and should we be worried? Yes, it can, but I think the problem with the Fed here in America, remember, let's just start with some basic things, right? The Fed in America has that dual mandate that we talked about, full employment and inflation, right? Other central banks, especially in Europe and Japan, don't have that mandate, don't have that employment mandate. And so, yes, I think the Fed can fix inflation. I think that they will not do it though, based on their other mandate of the high unemployment, right? We still have about 5 million people post-COVID that are not back to work, and I think that's probably the Fed's bigger issue for them, quite frankly. And I do want to say, I don't know if inflation is the thing that needs to be fixed either, right? And I almost worry about the premise of the question. It wasn't that long ago that some of the biggest concerns that I have and that the Fed central bankers has was not inflation, was deflation, right? Deflation is the much bigger issue for markets. It is something that's plagued Japan for decades now, because modern economics don't have really a tool to deal with that. And so it wasn't that long ago. I still think there are many disinflationary trends that are out there in the market. And so I don't know if that the Fed thinks that higher temporary inflation is a long-term problem that needs to be really addressed. Right, when you look at big investors like Cathie Wood of the ARK funds, right, she thinks that inflation is not really a problem. She thinks that technology is such a huge, disinflationary effect on the market, on the economy, on employment, that I think the huge advances in technology is really going to help keep inflation quite low for decades.
Yeah, I think that everyone remember that when you go to buy your big flat screen TV on Black Friday this year, and think about what it would have cost you 10 years ago. Technology is, it's one of those driving deflationary forces that's widespread in our economy. But with that, we're right after 2:30 here, so I want to thank both of you for your time today and educating all of us on inflation. And I want to thank all of our listeners. Thank you again for attending. We hope you'll join us again next time. This is our last webinar for the year. So keep on the lookout for beginning of next year for our first event of 2022, which will be in January. And with that, please, again, if you're around and you have the time, we would very much appreciate you completing the survey. Let us know how we're doing and what you'd like to see from us in the future. Thank you again.